Welcome everybody to the second part of our mid-year podcast series. Hopefully you've heard the first part, which we were looking at the macroeconomic conditions between now and into next year. This time we're focusing on the financial markets themselves. Now, our mid-year outlook is titled Making Hay While the Sun Shines, and that applies both to the macro side as well as the financial markets. So what do we think about financial markets from here? Well, we have been big believers in the equity story, the continuation of the bull market in equities, and guess what? We think that continues into year end. Yes, there'll be some volatility, but broadly speaking, as you'll hear, the drivers of equity markets we feel very much remain intact. Now, that's not so much the case when it comes to credit markets. Yes, they've been performing well. You'll have all seen the massive issuance and the demand that has met that issuance in terms of credit markets. But look how tight spreads are. They're very, very tight and close to that lower bound. So we don't really see a great deal of upside there, although we're not expecting, frankly, a lot of downside either. But on a risk-reward basis, equities, we believe, are still favored over the credit markets. So what about government bonds? Well, actually, we think they are around fair value. We've seen volatility in government bond yields over the course of this year. And frankly, we've said that's a good thing. This is putting pressure on governments to be careful in terms of how they spend, to be thinking very much about deficits and the debt levels that they have. So a bit of bond volatility is actually not a bad thing. And we do see that largely continuing through the remainder of this year, but it's more like range trading around the current levels that we've seen. So given that very broad-based outlook, I want to turn to you, Puneet, to get a kind of a flavor of really why are we thinking that, what are we thinking are the main drivers of that, and how sustainable is this that I'm talking about?
I think we think the equity bull run is fairly sustainable. We do think that, there are a number of factors behind it, actually. First of all, we think that the policymakers are quite keen to actually support an equity bull market. Yeah. We have seen, the
US policymakers.
The US policymakers in particular. Yeah. But also, I think other parts of the world, for example, like Japan, we are seeing a fairly good, changes on the fiscal side, which are supporting the markets. And I think, that's key positive driver in the first place. Second is that the economy is by and large resilient overall in many parts of the world, including in the US, where it matters the most, despite the fact that we saw, an oil price shock for a small period of time, and then we also saw, a tariff shock in some sense, but the economy has been powering through, and we see super strong earnings actually coming through as well. So the fundamentals of the market are already positive, and we expect that to continue. I think the most important driver of the market clearly is the boom in AI or, the continuing AI capex cycle, which many of the large hyperscalers that we discussed in the previous section are committed to actually sustaining for some period of time. And we think that's a sustainable move. This is not something which is a fad today and will be out of fashion tomorrow. We do think we are seeing, improvements in technology which are very real and, will change the way things happen. Yeah. And therefore, the spending on that will come through and will have multiplier effects on the rest of the economy. Sure. And that is not yet fully priced into the market. So therefore, we would be positive. And the funding for that also, as we discussed in the previous section, is quite sustainable because it comes from, the credit markets, comes from the organic cash flows of these companies. That's why we see, for example, the beneficiaries of the AI boom, such as the semiconductors, doing extremely well. And that's also across the world, not just in the US. So by and large, I think the equity story is one which is positive. There will be times where things will get a little bit overdone. Too hot, too cold in a way. But, by and large, we do expect the bull run continues.
I think you raise an interesting point, because what you're effectively saying is these very high quality hyperscalers, well, at least most of them, they've got very robust balance sheets. They're not really taking on a lot of debt, a lot of leverage at all, really. And yet they're able to raise that in the markets. And that money is being recirculated in terms of their own spending into other parts of the IT space. That's basically what you're saying. This is a sustainable move higher.
Exactly. I think, all hyperscalers are not the same. Yeah. Clearly, there are a couple of exceptions, and we would be, from a credit markets perspective, be a bit more worried around not worried as such, but watch closely, companies like Oracle and CoreWeave, etc. But by and large, I think yes, absolutely. I think, and the leverage being increased is not substantial. And despite the fact that, some of these headline numbers are enormous. So if there is any segment, I would be much more worried today if autos were increasing their leverage by the same amount, for example, or they were spending so much. So I think that is a positive, which I think will drive the markets. I mean, in addition to the fact that the economy to start with is fundamentally resilient, and the fact that governments are boosting the prospects of the economy.
Is there anything you're looking at in the credit markets? Because what we've just described is the credit markets funding a lot of the equity earnings that we're seeing, and as we know, they're kind of record levels there. Is there anything in the credit markets that you're watching as that kind of canary in the coal mine to gauge when this might be slowing down? Because I guess we all know that financial markets are about second derivatives. So when is that rate of change beginning to become more problematic, do you think?
I don't see that at all right now. Because, I mean, if you think about the demand for these new issues, which is where I would look at, you are seeing extremely strong demand, or at least strong demand, let's say not extremely strong. I mean, NVIDIA's and SpaceX issues, again, getting oversubscribed by 4 times. I mean, we also saw that in many other issues which have happened as well. I think the key areas to watch for a rate of change would be to monitor the CDS levels of companies like Oracle, company like CoreWeave, and also SpaceX. SpaceX is actually quite hot in the market now, having done both equity and bond issues. The CDS has just started trading, and people are focused on it. And I think one of the strategies which I would think many investors would do would be to hedge some of their upside exposure to equities by using credit markets, where your downside is limited through a short exposure. And that's where I think some of these weaker names within the AI space will see a price action before there is any rate of change.
And that is indeed one of our favorite trades, and we'll come back to the credit element perhaps a little bit later. But taking that positive equity view, I want to turn to you, Tom, because Puneet mentioned a lot about the hyperscalers in the US. I mean, the US is the biggest, deepest, most liquid, most dynamic market in the world, the place that you want to be. We've seen over the last 12 months it kind of fall a little bit in and out of love with investors. We went from that period about US exceptionalism to perhaps not so US exceptionalism, and maybe back on again. So US equities, how do you see the prospects from here? Yes, they've done quite well, but they've not done as well as, and we'll hear from Ha in a minute, compared to some of the pure play tech names in Asia. So what are the prospects for US equities?
Well, look, first of all, you have to take the bigger picture, and it's still a very robust framework. In the first video, we talked about solid economic outlook. Clearly, if we zoom in on the equity market or on stocks and companies in particular, I mean, earnings growth rates of above 20% year on year, that's still a strong number. So you would expect that, yes, some of these tech companies are not cheap anymore. That's true. But if you compare it to the strong growth rates, these companies are highly profitable. They have really high margins. They have high revenue growth. They have pricing power. So clearly, it's still a very solid environment. Sure, you did mention the ups and downs, and I think that's another positive sign. It's not a sign of exuberance, and like, for example, if you compare it to the dot-com bubble, like everything that has tech, or in this case AI written on it, needs to be bought. Investors do differentiate. They do look at who might benefit from the whole AI boom, or the broader. We're not only talking about AI, we talk about quantum technology, about biotechnology, about space development. There's lots of things going on. We're living in very interesting times. But the fact that it's not the whole market valuation that is exploded, I think it's a positive sign. So investors still do differentiate. And the ups and downs we see has to do with the fact that clearly the main beneficiaries of the AI capex boom are hardware companies, particularly semiconductors. We'll talk about that even more when we talk about Asian markets. So it's not necessarily all of the hyperscalers like Apple, for example. Recently, we have seen Apple had to raise its prices because of higher input costs, triggered by the bottlenecks in the hardware market. So clearly that was not taken very positively by investors, because they start to realize not everybody will benefit in the same way. And that's, as I said, a good thing, which means that, well, it's not the sky is the limit. Clearly there is robust upsides. We do believe in strong growth rates. We do believe in strong capex, but it's important that investors keep differentiating between who's likely winner and loser.
And we should say to our viewers that we're not perma bulls on the markets and technology. We know there's a multitude of risks, and we might go into some of those in a minute. But maybe one risk actually, or maybe it's not a risk, is the amount of issuance. I mean, Puneet had mentioned about the amount of debt issuance that's coming to the market. We've seen SpaceX come, obviously grabbed all the headlines, made a $1 trillion man out of Mr. Musk, or did. I don't know if he still is. Tell me, we've also got the possibility of Anthropic coming to the market, OpenAI. One could say we've got a lot of very high profile, very big deals coming. Does that absorb the investor demand? They have to participate in these, they have to sell something else to buy them. What's your view on that kind of?
Well, my overall view is until very recently, people did worry about the de-equitization, or there's fewer and fewer stocks available. So we should actually welcome the big IPOs. I think it's also part of how the structure of the market works, how private equity works. They come to the market later than they used to, so obviously companies are already bigger. But in no way I do think that this kind of dries out funds or liquidity in the market. I mean, we have seen examples. You mentioned SpaceX, clearly a very successful IPO. Maybe you could see a little bit of exuberance there, but clearly investors were willing to soak up all the issue, although the free float was relatively small. For me, that's an indication that at least as of now, as we're speaking, there is still plenty of demand for new issues, but also for existing listed tech companies. And that is a positive thing, clearly.
Let's see how that rest of the year develops. But net, you think that's not a bad thing for the financial market. So turning to you, Ha, because again, Puneet spoke about this circularity. Hyperscalers are able to have through their own balance sheet and raise through debt issuance a lot of, or gain a lot of liquidity. That money is being put to work in the space, particularly around semiconductors, and we see that. We mentioned it again in prior videos about the DRAM prices. Now, Asia seemed to be one of the purest plays on this move. How sustainable is this? We're seeing triple-digit moves in some of these indices, no less. And within the indices, we know that they're heavily exposed to one or two companies. So is this a pack of cards or a house of cards just waiting to implode? Or is there something more long-lasting here, do you think?
I think the short term, clearly there are some markets, for example, in Korea, for example, we see a lot of leverage positions just basically on two names, SK Hynix and Samsung. So yeah, I don't think it's a healthy market.
That's these like levered ETFs that people are taking on. So if the market goes up by 10%, they go up by 20%. Thank you very much. There's also a downside to that. But is that is a concern to you?
So I think the market, some markets like Korean markets can be quite frothy, but the correction that we saw, the volatility that we saw in the last couple of weeks actually is very healthy to clear out some of the froth out of the very extended markets. Now, does it mean that we have AI bubble busting, or does it mean that we have like the AI story derail? I don't think so, because if you just simply layer the price change over the last 1 year over the revenue or the sales and earnings that those companies delivered, is actually quite justifiable. And in fact, if we look at valuation, for example, forward PE is actually still very cheap.
I mean, just to make that clear to our viewers. So basically, the stocks and the indices are up a lot, but the earnings are up as much or more, which means the multiple, the PE, is actually come down. And I guess in some cases, it's got pretty close to single digits. So it looks optically at least cheap. Is it cheap?
I think yes, with the level of revenue and sales that they deliver. Just thinking about the whole world, we have 3 companies that actually produce memory chips: Micron, SK Hynix, and Samsung, and they can price anything at the moment. They have such a pricing power. Thomas mentioned about the supply bottleneck, so you can see DRAM prices, token prices also elevated. So clearly demand is outstripped supplies at the moment. And with that pricing power, I think this kind of story from AI still continue to run. Of course, there's a little bit of a short-term corrections, and that is actually very healthy for this company continue to deliver from the return perspective.
I'm old enough, and I said this here, I'm old enough to remember the old days was as an equity investor in cyclicals, particularly semiconductors. you bought them when they were expensive and you sold them when they're cheap. And I know you laugh at me saying that thing, but the reason we did that was because, if you were buying them, when they were expensive, you knew that actually the earnings were going to turn and actually suddenly they were going to become cheap for the reasons that you mentioned, because then the surprise and positive. Equally, if you were buying them when they were cheap and the earnings look great, then they'll turn. I mean, it's just the way cycles go. It sounds this time we believe there's more visibility in that cycle, that simply the bottleneck from the way you describe it is so great that time is on our side. Given what Puneet was saying, there is a visibility into the funding, and we know that it takes some time to build out these fabs. So that's what we're playing here. We're playing the fact that this could last for longer. Yeah. Not that we've seen an end of cyclicality to semiconductor plays.
No, I would call that this is a tech super cycle, really, because in 2000 we talk a lot about technology, but back then is the born of the internet, and after that we have software, actually very capital light. Yeah. And this cycle is actually a capex story. And to build that infrastructure, what you need memory chips, you need equipment, and those Asia, the biggest strength of Asia is manufacturing, and we just not manufacture anything. We manufacture tech, and we have a top company still sitting in Korea and Taiwan. So if we believe that AI really has that transformative power to change the way we work, and clearly I think there's still a lot to run for this company.
Now we also, you like sort of some of the North Asian economies, some of the EMs there, but you also like Japan. I mean, Japan is also a story you think has got further legs. So why is that?
There are two stories that are happening in Japan. If you look at the index and we break down to sectors, there are a lot of that in technology, and it's particular semiconductor. So Japan might not be, the countries that produce a lot of chips like Korea or in Taiwan, but that produce the equipment. And there are a lot of things come together to form the tech ecosystem, right? So Japan can participate in that front. At the same time, we see banking sector in Japan has been doing quite well because profitability picking up. We have Japan
as rates go up,
As rates go up, we have steepening yield curve. So both of that, I think we can benefit. It's always a diversification play outside of very concentrated, very heavy tech.
You say diversification. Like we're still playing Japan for a lot of the tech exposure. You kind of imply, a lot of these big multinationals have got some very profitable, very exciting tech arms, and that's something else that we want to get exposure to.
Exactly. Okay. And also the positioning is not too extended like we see in Korea, for example, so that is a good.
Thanks, maybe before turning to you, Gustavo, Ross, the exciting element around Asia, of course, is tech related. The exciting element in the United States is around tech. One place I'm not sure there's much tech is Europe. So we spoke about the economics in Europe being a bit dull. The financial markets, they look a bit dull as well. Is there any reason why we should think about being overweight European equities right now?
The honest answer is I prefer to use Europe as a funding leg for other high conviction trades. We've talked about it at length. I think there are genuine, profound reasons to want to be long with respect to the AI theme. Europe does have exposure. So I want to make this point clear. Yeah. Europe does have exposure to AI. Directly in the case of ASML, downstream with respect to construction of data centers, massive energy build out. But the fundamental reality is the constituents within that index, the weights within that index are just a low quality way to play that theme generally. Yeah. There are structural problems that we spoke about before that I think have been coming in slightly more disappointing than expected. And that, in my view, is going to continue to weigh down the broad index. I like some companies within Europe, certainly from an equity perspective. Aggregate, I think it's.
But here's the thing, Ross. Are we putting a bit too much weight on technology? Because despite the challenges, there are a lot of very good companies in Europe. And we saw last year, actually, sometimes Europe appears to be able to punch above its fundamental weight, if you like. Is it a possibility we see the same thing again? People diversify a little bit, and it only takes a little bit from their portfolios from technology into perhaps a bit of a hedge, and Europe could suddenly find that it does very well?
It's certainly possible. That's a risk to my view rather than a base case in my view right now. I think actually what's more likely to happen is deallocation out of Europe, given there was considerable build-up of positive momentum from a narrative perspective, an actual flow perspective into European equities, I think can actually still unwind, and particularly when we look to the second half of this year, i.e. tactically. The other thing I would say as well is one of the fundamental diversifying drivers of the European equities' positive performance has been banks.
Yeah.
That's across regions within Europe. I think it's much less clear from here today. You can make a valuation case given how much of a re-rating we've seen within that. That's not to say, by the way, that I think the sector is going to suffer from big non-performing loans, asset impairment,
Sure,
etc.
yeah.
I just think that fundamentally the kind of the easy money has been made with respect to that valuation story. And then when again I look at other industries, it's unclear to me what is a better way of kind of playing tech that Europe is particularly exposed to. I don't see for the time.
So I get it. Not yet terribly compelling, but we keep an eye on it. We'll have another moment at some point, just not yet. Now, I want to turn to you, Gustavo, because when we speak about EM, we've heard the upside from Ha about the tech-heavy Asian EM markets. Not really the case in LATAM. It sounds a bit more European-like.
No, totally agree on that, Guy. I think when we began the year, clearly LATAM was a big winner this EM rotation, but well, erupted the conflict, and there was kind of even though it started to be a defensive market. Remember that LATAM is mostly focused on Brazilian equities, and these have a lot of exposure on the oil and gas energy sector. Well, clearly benefited on that, but then a lot of idiosyncratic risks have appeared. I think we covered on the previous video on macroeconomics, clearly one of the legs that prompted this attractiveness of Latin America markets was the great scope for easing cycle in Brazil that has reduced in terms of rising inflation expectation, a resilient economy, but also more idiosyncratic factors like the political cycle. We are entering into the presidential election period for Brazil, and the market expectation have shifted a little bit to the downside, with not a pro-market candidate losing momentum. So on that front, maybe losing attractiveness of the Latin America market, even though a lot of fundamentals continue to be constructed. Valuation clearly is one of the things, and also there are a lot of stories going on across the region without Brazil. Clearly, we have in Chile, for instance, we have a pro-market shift in terms of boosting investment, and also in Mexico, that even though this cloudy environment we are facing going into the renegotiation of the USMCA clearly is a big structural winner in terms of continue to accent the US market, but maybe we have clarity more going into the medium term.
Well, we'll keep an eye on that. As I say, there will be a time and a place for LATAM, maybe not just yet. Now, I just want to round up with you on the credit side, put it before discussing a little bit about government bonds. But you spoke about the issuance that's coming. Clearly, there's massive investor demand for that issuance. What does this do to the credit indices? Is this improving the quality? Because you also said that these are high quality companies. So is this changing fundamentally the nature of some of these credit markets that we're looking at?
Yeah, indeed, actually. I mean, many of the companies, for example, are now AA rated, which are issuing a lot of the bonds.
Yeah.
So typically the credit markets have been, for example, the US investment grade credit markets had roughly around 50% triple Bs. So as many of the hyperscalers come to the market, I mean, the average quality of the market will increase. And, what we'll also find is that people, however, will face some concentration risk, because these are just a few names in the hyperscalers. And if they are going to issue, quite a few bonds, you will find what people get exposed to in terms of concentration.
And I mean, they're also issuing in different currencies, right? So that, I guess, will help some of that. The duration also varies. So putting it all together, do you think they're smartly managing this to make sure they can optimize the number of investors that can get in?
Yes, absolutely. And I think they're all aware of many of these concentration issues, clearly. And I think, by issuing across currencies, issuing across tenors, they're trying to improve their own, liabilities in a way. I think what I must say is, like, the demand for the longer end, for example, for SpaceX deal was lukewarm compared to what it was for the front end. And I think that's a function of, a few things. I mean, these are rapidly changing technologies. And I think buying like very long dated, 50 or 100 or 30 or 40.
But it was Alphabet. They had a 100-year
Yes,
bond, wasn't it?
yeah,
I mean,
yeah,
are you expecting any more 100-year bonds, or have we seen it for this cycle?
No, I think we will have more because there is demand in certain pockets of.
There was, yeah, absolutely.
Yeah, exactly. And I think people are short of duration in certain areas, and they have the pension fund demand and institutional demand. So there will be more of them. But credit investors, I think, with respect to pricing of the spread and so on and so forth, would probably I think in most likelihood price in a discount for the longer dated tenors simply because of the risk.
I mean, just to be clear, what you're really saying is that the credit markets are actually in pretty rude health, actually.
Yes.
But again, risk reward, we just favor equities over that because there's more upside.
Yes, I think mathematically the upside is limited in credit spreads because the US investment grade credit is currently around 70 basis points, a bit higher than that. And the most it can tighten to is probably a few basis points or so. So that means you will have probably carry-like returns, maybe slightly positive returns in an environment where equities will return much more. And I think that's where the downside is, the upside in credit is limited. On the other hand, if things do become bad suddenly, let us say either
the downside is very obvious.
The downside is very obvious in credit. So that's why we like, the equity versus credit strategies.
Good. So let's switch gear again, Tom. So we're talking about these very high quality mega cap US companies and the very high ratings they have got. I mean, I still believe governments generally command a higher rating than even the best companies. But let's turn to the US government, because we have seen treasury markets under a bit of pressure. We mentioned this earlier on. Thinking about your focal areas, particularly gilts and treasuries, any particular nuances? We've spoken about them being around fair value, but are they tradable just now?
Well, look, I mean, as I said, or you mentioned it, US Treasuries around fair value, I would say, clearly a bit higher than in recent years. But that has also to do with overall higher inflation expectations, higher inflation uncertainty, and clearly still a fiscal deficit that is above 5%, has been above 5% for years. So while we don't worry about imminent problems with regard to the US fiscal situation, it still can be considered to be a bit, I wouldn't call it reckless, but safe in good times to have money to spend in bad times. And clearly the US is not doing that. So there has been some upwards pressure, but we also mentioned it before, and I think in the first video, that particularly the current administration is very kind of sensitive to what's going on in markets, and that applies to both the equity market but also the bond market. And we have seen several situations where the 10-year Treasury, for example, approached 5%, 4.8%, and that was usually a bit of a trigger for the turnaround in policies and politics. So I wouldn't say Treasuries per se are a massive trading market currently, because they are at the level that I would consider a fair. Similarly, gilt, because you mentioned it, gilts clearly much more fragile because the fiscal situation is probably even a bit worse than in the US, but clearly the economy has a much weaker backdrop. So there is much less buffer, so to speak, in the UK. And on top of that, you had political risk. We mentioned it during the macro video. We now have a change in the Prime Minister. So the UK market has been more volatile because it has been more affected by what was happening globally. The spike in oil prices, the spike in inflation, that clearly, although obviously nothing had directly to do anything domestically with what's happening in the UK, the UK market, the gilt market, was more affected.
I mean, I always see it as like almost a lightning rod of what's happening around the world because of the size of it, whatever. So we've seen that move quite...
Exactly, and we have seen the opposite now also with the massive drop in oil prices. Inflation expectations globally fell back, and gilts actually came back more than other markets and other bond markets. Now, one big difference, maybe, or one interesting gap or spread that we look at is, we talked about treasuries being maybe roughly fair value, maybe a bit of upside risk if inflation is not coming down as fast as expected, given the robust economic backdrop. But clearly, if we look to Europe for that matter, we have bunds, and I will hand over to Ross for that, but bunds clearly also are at levels that we haven't seen very often in the recent years. So clearly there seems to be a bit of a mismatch if you look at the actual fundamental situation and where bond yields are traded.
Yeah, totally. No, thanks, Tom, for bringing it up. I think it's totally true. I think it's a very simple story in Europe. Rest of the year, expect European duration or bonds, we say generally, simplistically, to outperform other developed markets, primarily because the money markets are too pessimistic with respect to expected rate paths. ECB rate hikes, I think there's too many priced in still, that's going to come out. I also think fundamentally the market has not fully reassessed the outlook in terms of growth and inflation. We talked about in the previous podcast. It's not reflecting that in prices yet. The risks are clearly skewed, in my view, towards lower yields to outperform other markets, particularly, of course, by the way, because the ECB is putting its foot on the brake of what is specifically the main driver of European growth, i.e. massive capex growth, spending as well in a variety of areas. Last thing I want to say in European govies, carry positive environment generally. Think things like Italy, Spain, tight levels, historically tight, levels back to where they were before the sovereign debt crisis. I think that can persist. Again, we spoke about reasons for that in the previous podcast. France, keep watching that. I expect it to underperform as we head out of the summer. Risks around there, not just political, underlying debt and deficit dynamics are unfortunately deteriorating again. So I suspect that will be a point of discussion in our next podcast as well.
More pain ahead for Europe, but a money-making opportunity, as you see it. Let's watch that space, Ross, and see how it develops. I want to just conclude with you, Ha, because we mentioned in the last podcast, and credit to you, about the views around JGBs and where they were going to go this year. At the start of the year, your topical said they would go to 280 for 10 years, and you thought maybe the upside could be 3, and we've got a 280. Will we see 3? Or are the days of hitting 3, do you think, now past? Has the government tempered its spending ambitions?
That's a good question.
Thank you.
I think for this year we hit 2.8. Clearly, the government had not tempered the fiscal spending. Of course, after the energy crisis, there are a lot of fewer subsidy, for example, in a strictest form, basically cap the gasoline price at 170. So basically everything above is going to directly hit the government budget. And more measures actually coming out. We're talking about maybe sales tax cut. And remember last year when we have a supplementary budget that announced that where we see a spike in bond yield. And that might be this year, towards the end of the year, we'll have another supplementary budget being announced and might be more than expected. So I think with that propensity of spending coming from the fiscal policy, I can see market can well test 2.8%, and the volatility will stay high, whether it stay, because hitting 3% and staying there anchored 3% is a different things. I think every now and then it can hit 3%, but I don't think that is where it's going to anchor at that level. Now, the other side of the coin is the BOJ, right? So the BOJs being perceived by the market that basically is behind the curve. You can see that in the currency is still testing 160 at the moment. And if you have the central bank not having a very decisive move to say we want to anchor inflation expectations, that is where we see bond yields going wild. And that dynamic still remain the same since I wrote the topical paper together with Ross at the beginning of the year. Nothing have changed really. So that predictions or that forecast still remains in place.
Very good. Yes, indeed, it was a good double act with Ross there. So turning to our viewers, I hope you're still with us. I hope you found that interesting. So you will have gathered, still bullish on the equity markets for the kind of the reasons we stated. There's a tech cycle going on. There's abundant liquidity in the markets. There is a hope and view that actually the worst may well be behind us in the Middle East. We'll have to wait and see. But broadly speaking, with the kind of the normalization of oil prices, that's certainly helping. As I said, there is a lot of appetite out there for both stock and for credit market offerings there, but they're being well absorbed by the market. So we always, of course, have to expect volatility in markets. That's what makes them so much fun and sometimes a bit painful. So we'll keep an eye on a lot of the developments that are going on there. We don't think this will be a straight line into the end of the year. We are expecting, of course, further geopolitical challenges ahead. There always are. And we will have to get through, again, a number of earnings seasons. Watching out for any kind of slowdown in that second derivative. Is there any sign that spending on IT is beginning to lose some of its oomph? Because I think that will be important. And perhaps the most important thing of all for these financial markets, where are we really to see the Fed moving interest rates up? In other words, the start of a hiking cycle. I think this will be very difficult for risk assets in particular to make a lot further headway. But that's not the view. Our view is that we still see further upside ahead. And within the asset class space, we still prefer equities over the rest. Thank you very much for joining us. If you haven't, please look at the macroeconomic view where we take you around the key regions there. As always, you can read the full report on Zurich.com, and we will be back again very soon with something else.